warm welcome to everyone present on the call today. Just before we start the session, I'd like to introduce you to our speaker today. His name is Chinmay Kale. He is a CA and he is a seasoned tax professional. He specializes in direct and international taxation. Chinmay will be sharing his screen. If you guys have any concerns, maybe you can raise your hand or put in the Q&A. The access has been shared to all our, participants. I guess I will let Chinmay take over.
Sure. Thank you. Thank you very much. So my name is Chinmay Kale, as she introduced. Thank you for the brief intro part. So I'm a practicing chartered accountant based out of Bangalore. So I'm associated with ClearTax since more than 6-7 years, right? So we are providing advisory services, knowledge sharing sessions for the multiple financial advisory services to the multiple people, right? So in this today's sessions, ClearTax in association with IMT Care, we are trying to provide the financial wellness program where we're trying to talk about like what and all the major income tax related exemptions and deductions are available, and what is the difference between the old tax and new tax regime, and what are the precautions to be taken like while you're choosing the regime, and how to stay notice free, right? What are the simple steps that we can avoid? So this is the today's agenda. So if you're talking about so first we'll talk about like certain tax benefits in terms of the exemptions and the benefits, and later we'll talk about the deduction benefits such as ATC, pension, and what and all the things are there beyond ATC, right? Later we will talk about like old tax regime and the new tax regime, few of the illustrative examples based upon the various ranges of salary, and what are the factors to be considered while choosing the regime, right? At the end, we'll talk about what are the simple habits that we can follow in order to stay notice free or avoid notices, right? At the end we will keep the Q&A. So the things how will I take up is that like initially I will come up with the topics I wanted to discuss, and the last 15-20 minutes we'll open up the session for the Q&A, and you can please punch in your questions in the Q&A box. At the end I will take up those questions to the extent possible, and the rest of the things we'll make sure that we will get it answered from our expert panel, right? So just like provide a thumbs up, like if you're able to see my screen, my voice is clear, video is properly visible, right? So you just give a thumbs up, so that will be going to help me out, right? Cool. I can see if you have the thumbs up. So let's not make any sort of a delay. So we'll directly dump into the session. So when we call about the income tax, right? So income tax is something, one of the sources of revenue for the country, right, as an India. So along with the other source of revenue, such as revenue from the exports that we do, and the tax collections, toll collections, right, other sort of the taxes, and also few of the borrowings that the government do as a part of the inflow of the money. The taxes in the form of direct tax and the indirect taxes results in the major revenue sources, which in turn like it will help the country to uh, put an investment, right? So make an investment for the betterment of the economy, right? So this is a brief background why we pay the income tax. And being a salaried people, we pay generally the salary taxes as per the slab rates. So against that, in order for the fulfillment of the salaried responsibilities, so any direct expenditure related to the salary we claim it as exemptions, and any of the investments or the betterment of the social well-being, if we do any of the contribution for that, we will get the deductions, right? So we'll talk about the tax exemption first. So the first one is the popularly is the HRA, right? So HRA and the LTA, these are the two popular exemptions. So HRA is mainly given for a house rent expenditure that an salaried individual incurs, right? Generally we are like not be staying in, not be like brought up or not be grown in the place where we are currently working. Generally we move from cities to areas where we don't have any households, like in order to complete our responsibility being an employee, so we have to stay in a rented house. So in those cases this is very much basic necessary, government have considered that, and they are providing the exemptions related to the house rent that we pay, right? There are three conditions are there. If you're staying in a rented house or a metro city, 50% of the basic salary is considered, otherwise it will be 40%. What is the actual salary? HRA is there as a part of your salary component, right? and the whatever the rent that you paid in excess of basic 10% of the basic salary, that will be considered, and the least of the three will be considered as your exempted value for the deduction or the exemption purpose. So the recently there has been certain changes for the upcoming financial year, that is 26-27. So where the list of the metro cities were four, right? And to add adding to that, they have added four more cities. One is Bangalore, Hyderabad, Pune, and Ahmedabad. These are the four cities they have added to the list, and now they are exhaustive list of eight cities are there, right? So second one is the leave travel allowance. So leave travel allowance is can be claimed only if you are making a domestic travel, right? And it can be exclusively claimed only for the traveling purpose, right? So if you are like going for a vacation, right? So in that case, there can be like traveling as well as accommodation as well as expenditure, right? So accommodation and the expenditure will not be coming to picture. Only the travel cost, that is to economic airfare or the first class train, where these are the only two things are allowed. If you are traveling by road, there is no provision for that, right? Generally, these leave travel allowances can be claimed 2 years out of the 4 years, up to a maximum of rupees 2 lakhs, right? So, and this travel has can be like along with you, it can be your spouse, children, and the dependent parents and the siblings can also travel. Make sure that they travel along with you, so that whenever the boarding pass or the airfare ticket that you provide for the exemption claim, your name is also there along with your spouse and the other family members name, so that you will become eligible easily, right? So these are the two major exemptions I can say, right? The second one is basically the relation tax benefits that we can claim in respect of the house, right? Having a house is a dream of every person, I can say, right? So in order to encourage this particular dream, so the government is providing the housing loan facilities, right? So if you're taking a housing loan, and if you're claiming the tax against those interest paid on that particular housing loan, you will be able to get the tax benefits. So generally, we will not be able to make any kind of an investment, right? So upfront entire investment, it is not possible. So generally, we go with the 10, up to 25% of the down payment, and rest of them we generally go for a loan. In those cases, up to 2 lakh rupees interest on a housing loan that can be claimed as an interest. So there can be two types of homes, right? So one is constructed property which is ready to move in, and another one is that we will buy a piece of plot and we will construct the house. Then once the construction is completed, we will move in. So if it is ready to move house, if you are taking a housing loan on the date of the registration itself, then the interest can be claimed from the day one itself. There is no hard and fast rule for that. Straight away, whatever the interest is paid, that can be claimed. But in case of under construction property or a construction property, which is not ready to move in, the loan will start from the day you have taken the loan for the construction. So till the time you get the occupancy certificate, the interest on this housing loan will cannot be claimed as a part. It will be determined as pre-construction component of the housing loan, right? So in those cases, once the construction is completed, whatever the pre-construction interest paid is there, that can be claimed over a period of 5 years equally. Say that if you have incurred like 1 lakh of interest on housing loan before the construction is completed, then this 1 lakh amount, it can be claimed in the next 5 years, 20,000 each, along with the current or the post construction interest component also, right? So this interest on housing loan can be of up to rupees 2 lakh can be availed by the co-owners individually. If there are like multiple, more than one owner is there, say if you have like purchased the property along with your mother and wife's name, there are like three people are there, so each of them can enjoy this 2 lakh limit, so that you can properly plan it and claim that. Even the interest on the housing let out properties also can be claimed against the rental income, right? So the interest that is paid, so in case of the let out property, you will get the rental income, right? To that extent, you can claim the interest on the let out property. So both these benefits, which I discussed, so in the before slide and this particular slide. So unless I mention, these are the exemptions or the deductions that are eligible under the old tax regime only. So if any specific exemptions or deductions are eligible under the new tax regime, I will specifically highlight that whenever it comes out. If I like miss out to tell, I presume that it is eligible under only under the old tax regime. Okay. So other exemptions that are eligible, other expenses that are eligible for the exemptions are books and periodicals, driver allowances, meal allowances, petrol and direct. Any like particular expenditure that is directly in relation to the fulfillment of the employee responsibilities or the employment purposes. Say that books and periodicals that we use in order for the upskillment of our for in order to fulfill the employment. So that can be that particular benefit has to be made as a flexi benefit plan from your company itself. Once that is made available, you can claim the exemption against that. Right? Driver allowances, similarly, for the commutation purpose, you may be like having the petrol and the driver allowances. Those can also be claimed subject to the organization policy. So, meal allowances earlier like 50 rupees per meal is was allowed as an exempt. Now it has been increased to 200 rupees. So up to 26,400 rupees can be considered as a exempt under the can be claimed as an exemptions provided this meal allowance is part of your salary. These are the other expenses eligible for the exemptions. Now we talk about the deductions part. Like we are like either you are like investing the money for the specific in the specific instruments, or you are like making certain contributions for the betterment of the society. Like in both the cases, the benefits will be eligible under the Section 80 series. So one out of which one of the section is ATC, where you can make maximum claim the benefit of 1.5 lakh. So there are like various avenues are there where you can choose the instruments under which you can make the investments, right? First one is the provident fund. There can be two types of provident fund. One is the employee provident fund, and another one is the public provident fund. Employee provident fund is something like where the tax is getting deducted from your salary and it is getting invested along with the employer contribution. Both will be there. Whereas under the PPF is a public provident fund where it can be opened under the name of your like in your name, spouse or a children. So it will be having a certain lock-in period up to 15 years, subject to a withdrawal of after 8 years. So you will get a fixed interest on this PPF amount, whereas in case of the employee also you will get a fixed interest amount. So in these cases, you can invest in the provident fund and get the deductions under this particular section. Life insurance premium, like there are like multiple insurance policies are there. One is life insurance, term insurance, health insurance, vehicle insurance, right? Under ETC only the insurance that provides the cover for your life, right? There will be sum assured after the completion of the insurance period. If in case of any of the unlikely event like death or the death has to happen, in case of that the payment will be made to your nominee. So whenever there is a coverage of the life, right? So there is also another insurance is that is the term insurance where the sum assured is not there. Only in case of the unlikely event, they will pay the money only to their nominee, not to the person who is providing the taking the policy. Policy holder will not be getting any of the benefits under the life insurance. If the upon maturity of the policy, he will also be benefited with the fixed sum assured that is promised by the insurance. Only those policies will be covered under this. So there are like the additional conditions are there, such as like the policy amount should not exceed 10% of the maturity value or the sum assured value. So those has to be considered. Otherwise, those will not become eligible under the ATC. The third one is ELSS. This is the equity linked insurance savings scheme, where you can make the investment in a mutual funds which is having a lock-in period of 3 years. So from the date you purchase the mutual fund units, it will be completely locked for 3 years. You will not be eligible, will not be able to withdraw at any point of time at any cost, right? So you will be getting the deductions up to rupees 1.5 lakh under this. And once it is matured, automatically it will be treated as a long-term capital gain. If it is in a profit, generally it will be in a profit over a period of 3 years. Only you have to pay the taxes on the capital gain part only, right? The principal or the maturity value that you withdraw, there is no payment required to pay upfront any taxes. Only on the profit element you have to pay 12.5% as per the existing rates. After 3 years, whatever the rates are prevailing, you have to make the payment on that. Next one is the housing loan principle. In the earlier slide, I spoke about the interest component of the housing loan. Here you can claim the principal component of the housing loan. And the next one is the fixed deposits, right? Tax saving fixed deposits are there, which will be locked for 5 years, right? And whatever the interest that you get from those placing the deposit, you will be required to pay the tax on that interest amount on a year-on-year basis, right? So here you have to decide like if here in the fixed deposit in the recent times, I can see like on a maximum to maximum, we will be getting 6.5 percentage for the fixed deposits, right? So, and it is lock-in period is 5 years, and on top of that, interest is taxable. Here, the return is also minimal, out of which on the interest which we are getting, that is also getting taxed. What is the benefit that we are getting from the keeping the money for a longer period? So you have to be wisely choose which instrument you have to, whether you have to go with the ELSS, whether you have to go with the PF, PPF, whether you have to go with the rather than taking all this fixed deposit and you make a better wealth management or a better wealth creation of any of the assets. Rest of the money you can keep it in the form of insurance, right? So you like take the financial advisor help like structure in a proper manner. I don't advise to go for a fixed deposit unless you are a very conservative investors. For them only nowadays I can see fixed deposit is mostly beneficial. Otherwise, considering it is not even beating the inflation also, right? Choose wisely when you are making any of the investments. And the next one is Sukanya Samruddhi scheme. This is specifically the scheme is eligible only for the girl child, right? So you can invest up to rupees 1.5 lakh rupees for a child who is aging up to 10 years, right? So you can open the this particular scheme once she obtains the Aadhaar card, right? And you start making the investment. Once she attains the age of 21, yeah, you can along with the fixed return. So here the government is promising 8.5 percentage, right? So this is the considering the fixed deposits, this is a better scheme that you can invest in, right? And is the safest since it is backed by the government. This is the safest instrument, and it is getting very good returns also. Upon compounding, you will get the complete complete exemption, and the post withdrawal whatever the money that you get, that is also completely exempted along with the interest amount. There is no required to pay any of the taxes on that. Tuition fees, any tuition fees that is paid to a for the education of the children up to a maximum of two children, you can claim the exemptions. To make sure that whenever you get a receipt from your school, college, or a university, it has to be specifically for the education purpose or the tuition purpose in the extracurricular activities, annual day program, sports day program. It should not be given, or any other donation. It should not be mentioned. Specifically, the amount mentioned against the tuition fees are only eligible. So get it vetted before you get the receipt from the school or the any of the institution as such. Next are the other not so popular instruments that are also eligible under the ATCR: National Savings Certificate, Senior Citizen Savings Scheme, ULIPs, Unit Linked Insurance Policies, Post Office Deposits, and NABARD bonds. So if you are like making the investment in any of these deposits, you will be able to claim the benefits under ATC as well, right? So next, once we bypass this ATC, there are like next opportunity is there, like one is the section 80D, that is insurance on the health premium paid on the health insurances, and another one is the pension products where you can like safeguard the future of yours, right? There are two types of things. One is the pension scheme introduced by the central government, and another one is the annuity pension plan introduced by the insurance service providers, right? Insurance service provider. First one is the investment in the annuity plan of the insurance service provider, mainly LIC, right? So if you are going to similar to the life insurance that you purchase, similarly here the annuity plan of the insurance will also be there, where you will be depositing the money. In turn, that money will get deposited to the risk-free investment so that your corpus is protected, right? Upon arriving of a certain age, that money along with the returns, it will be passed out to you. That is one of the kind of a insurance plan. Here, another scheme is the national pension scheme is introduced by the central government, where like two types of contribution are there. If you are a salaried individual, along with your employee contribution, employer will also contribute. On top of that, you can also contribute on your own. If you are a non-salaried individual, you can directly contribute on your own. So for that, deduction is also available. So if you talk about ATCCD1, that is talks about the employee contribution. So if you opt for this particular scheme, up to a maximum of 10% or a 14% of your basic salary, the NPS will be deducted and it will be deposited along with the equivalent contribution by the employer, right? ATCCD1, this is the employee contribution scheme, is eligible under old tax regime only. However, ATCCD2, that is the employer's contribution. So equivalent contribution that is done by the employer. So that is also eligible for the deduction purpose. This is eligible under both the regimes, new as well as old. Under the old tax regime, up to 10% of the basic salary is allowed. If you are opting for the new tax regime, up to 14% of the basic salary is allowed, right? So, but employee contribution of 80 CCD 1, right? So, up to rupees 1.5 lakh, which you are talking about. So, it is clubbed with the ATC cap. So, this is how the law has been made. So, contribution to ATC, any of the investment plus 80 triple C, that is the pension plan of the insurance provider, and 80 CCD 1, that is the employee contribution to the pension scheme. This is clubbed together. There is a maximum cap of 1.5 lakh, right? But however, employer contribution to 80 CCD2, that is separate. You will be separately, you'll be able to claim either 10% or 14% according to the eligibility. And 80 CCD1B is there, that will provide additional 50,000 benefits on top of this employer contribution. On top of this 1.5 lakh benefit, additional 50,000 is eligible if you are contributing to the pension scheme up to rupees 50,000 on your own, right? So 80 CCD 1B. So your additional contribution or self contribution as a part of the 80 CCD 1, these both are eligible under old tax regime only, whereas 80 CCD 2, employer contribution up to 10% or 14% of the basic salary, these are eligible under both the tax regimes, right? I hope like this got a clarity. And government started a new particular scheme, NPS Vatsalya scheme. So there is no much of a changes with the national pension scheme and the national pension scheme Vatsalya. So here, like, more Vatsalya is more like towards the conservative. So here, like, the opportunity is not there for you to go towards the riskier investments. Whereas under the national pension scheme, you can choose like whether you have to go with tier 1, tier 2, or tier 3. Tier 1 means like conservative, tier 2 is moderative, and tier 3 is aggressive, where the money has been invested in the stock market at a higher proportion rather than at the tier 1, right? So you can make the changes according to a requirement from time to time, right? This is all about the pension products. And what is going beyond the ATC, right? As I said, like, was one of the major contributor to this is the insurance payment on the health insurance, right? Premium paid on the health insurance part. In case of a non-senior citizen, in respect to self, spouse, and the children, you can claim up to 25,000. In case of the maximum, in case of the senior citizen who is aged more than 60 years, for them you can claim up to insurance premium of 50,000 rupees. So total benefits that you can claim under this is 25,000 and 50,000, including the preventive health checkup of 5,000. If your parents are not eligible for taking the health insurance policy because of their age or any of the other medical conditions, and you can still claim the medical expenditure directly up to rupees 50,000, right? Generally, this will be covered for the people who is aging more than 60 years. But if they're not becoming eligible for the health insurance altogether or the medical insurance altogether, you can directly claim the medical expenditures directly. Second one, the next part is ATDD and ATU, right? This is specifically to be claimed for the differently abled or specially abled individuals. ATU is for the self disability and ATDD is for the dependent disability, right? If the disability is up to 40, is more than 40% and up to 80%, you can claim a flat expenditure, a flat deduction of 75,000 rupees. If it is a severe disability of more than 80%, then you can claim a flat deduction of 1.2 lakh. What is the disability about? It is mainly about the inability of a particular person in respect to the core functionality, with respect to vision, with respect to hearing, or with respect to the locomotor. You are not able to walk at all, like, so in those cases we call it as specifically core problems or the core disabilities. Those set of people, those set of disability will become eligible under both of this, right? The next part is ATDDB, medical treatment for the self or a dependent, right? So if a particular dependent or a self is suffering from specific disease, it is not about the disability, it is about the specific disease such as cancer, AIDS, Parkinson's, right? In those cases, you can claim a maximum deduction up to rupees 40,000 in case of a non-senior citizen and up to rupees 1 lakh in case of the senior citizen, subject to the actual expenditure that you incur, right? Here, like, dependent will include your spouse, children, wholly or mainly dependent parents, and the siblings. It will get covered. ATE talks about the interest that we pay on the education loan, right? So in generally, in order to do higher studies for our children or for ourselves or any of our dependent person, we will be taking the education loan. So interest paid on the education loan without any cap. So whatever the interest that you pay entirely will become eligible up to a maximum period of 8 years. You can claim this particular deductions, right? So it has to be the education has to be recognized by any of the government of a particular country. It need not to be India. So if a particular person is going to any other outside country for doing the higher studies, if that particular education curriculum is recognized by the education board or education ministry of education or the central government, those set of education is only eligible. Otherwise, if you're taking a loan in order to do any crash course, in order to do any certification course, that will not become eligible. ATEEB, that is in relation to the purchase of electric vehicle. If you are paying interest on the purchase, interest on the loan in relation to the electric vehicle, right? So the interest component will be allowed as reductions, but the loan and the vehicle should have been purchased before 2023 of March. Then only it will be allowed up to a maximum of 1.5 lakh. If you have taken the loan, then now you are continuing to pay the loan, you will become still eligible. The fresh loans is not eligible for this, right? The second one, this is the overall highlights I can say, right? What and all the various benefits that is eligible under the old tax regime and the new tax regime. As I said, interest on the housing loan, ATC, ATD, and the donations and the interest on education loan and employee contribution to NPS. These are eligible only under the old tax regime. And whereas employer contribution to pension scheme, subject to a maximum of 10% or 14%, it will be eligible under the new as well as old, right? 87-year rebate. So whenever you are like income is up to a certain threshold under the old tax regime, if it is the income is up to 5 lakh, you will not be required to any pay taxes. The rebate will be helping you to nullify those taxes. In case of a new tax regime, up to 12 lakh rupees, you are not required to pay the taxes, and the rebate is going to help. How this particular value has been fixed, how why this 60,000 has been fixed, why this 12,500 has been fixed, I will explain it to you like when we go to the illustration part in the upcoming slides. So then you will get a better understanding of that, right? The next one is the HRA LTA. The exemption relation to the HRA and LTA is eligible under the old tax regime. It is not eligible under new tax. Similarly, the professional tax. Every month, 200 rupees will get deducted from our salary. That is eligible only under the old tax. Whereas standard deduction under the old tax regime, it is 50,000, and whereas under the new tax regime, it is 75,000. So under the new tax regime, since there are like curtailment of the other deductions and the exemptions part, so here you are getting the better benefits in terms of the standard deduction by 25,000 and employer contribution to NPS scheme by additional 4%, right? So let's see few of the illustrations, right? Before we go to the illustrations, we'll try to discuss what and all the highlights of the budget 2025. I'm not talking about the highlights of the budget that is recently happened. I am talking about the budget that happened in the last year, which is applicable for the ongoing financial year, right? So that this is the budget which is going to impact your filing of the return and the ongoing tax planning. So the upcoming financial years, the tax implications that has to be looked separately, that is going to start from 1st of April. So let's start focusing on the applicable changes for the ongoing financial year. First one is there are no changes in the old tax regime as such. There is no increase in the slab rates. There is no increase in the enhancement of any of the additional deductions or the exemptions. So all the exemptions or deductions of the slab rates applicable for 24-25 will continue for 25-26. Whereas the rebate for the new tax regime is enhanced from 25,000 to 60,000. That is, in the 24-25 financial year, the rebate was applicable till the 7 lakh of income, right? So where if your income is up to 7 lakh, there is no requirement to pay taxes. If it is crosses 7 lakh, you are required to pay the taxes. Since there was a threshold of 25, now it is enhanced to 12 lakh rupees. Additional 5 lakh benefit has been given, so there is an enhancement in the rebate as well, right? So, but this particular rebate which you're talking about is applicable only for the slab rate income. The special rate, that is the flat rate income that we generally call in case of the capital gains, in case of the income, VDS or the cryptocurrency income, in those cases, flat rate will be applicable on your profit, that is 30%, 12.5 or 20%. In those cases, this rebate will not be applicable. Only on the flat rate, slab rate income, it is applicable. So updated return, this is the ITRU, we call it as. This is one of the opportunity has been provided by any of the taxpayers. If they have missed out to file any of the tax returns for the earlier years, or if they have committed any of the mistakes while they are filing the return, the window has been opened for them. They can rectify those mistakes in order to become compliant, right? So unnecessarily, if you don't want to get it prone to like scrutiny assessment or any of the investigation, in order to avoid that, in order to get ourselves straight, we have the opportunity to file the ITRU by file, but the additional penalty and the additional taxes will be there. But so once the scrutiny or any of the investigation from the department happens, that will be like more time taking process where it will take your mental peace also, and the additional penalty will also be there on top of the interest and everything. In order to becomes tension free, or in order to become compliant, this opportunity can be used by any of us, so that to get ourselves compliant, right? So the TDS and the TCS limits have been changed for the senior citizens and the educational purpose remittances. This is not of a great importance. We can skip for the moment, right? So these are the tax slabs that are applicable for the current financial year 25-26. Under the old tax regime, that is up to 2.5 lakh, there are no taxes. Up to 5 lakh, it is 5%. Up to 10 lakh, it is 20%. Anything above 10 lakh is 30% is flatly taxable, right? Whereas under the new tax regime, whereas under financial year 24-25, right? In the like in the slab rate difference, the intermittent slab rate difference was 3 lakh rupees. So now that has been enhanced to 4 lakh. Every 4 lakh, you have to pay incremental 5% of taxes up to 24 lakh rupees. Anything above 24 lakh rupees, you have to pay 30% of taxes. On top of that, you have to pay cess at the rate of 4% and surcharge whenever it crosses a limit of 50 lakh and 1 crore. The surcharge will also become applicable, right? So I was talking about up to 12.75 lakhs or 12 lakh rupees, there is no requirement to pay the taxes. Say that how it is that rebate of 60,000, how it comes to picture, we'll try to understand that part, right? If you are like income from salary is 12 lakh 75,000 and you are opted for the new tax regime, right? You will get a standard deduction of 75,000. So there will be a gross total income of 12 lakh, right? We can apply the slab rate of on this particular 12 lakh up to 4 lakh, 8 lakh, and 12 lakh. Automatically, the tax liability will come to 60,000. So, in order to, as the government promised, up to 12 lakh rupees under the new tax regime, there is no taxes. Entire 60,000 will be exempted in the form of rebate. There is no requirement to pay taxes, right? So what if this particular income crosses 12.75 lakh salary, or like your any additional income is there in terms of interest on your bank deposits or dividend income, capital income? What happens if it goes beyond 12 lakh? Will that rebate be still applicable? The answer is no, right? This rebate is applicable only if the income is up to 12 lakh rupees. If the income is crosses even by a 1 rupee also, right, exceeding 12 lakh rupees, in these cases, this rebate will not be applicable. You have to pay the income on your entire amount, not only on the income that is exceeding 12 lakh, on the entire amount you will be applicable. Again, you have to calculate up to 4 lakh, 8 lakh, 12 lakh, and whatever the additional income is coming on that, 15% has to be calculated according to the slab rates. This rebate will not be there, and the entire amount you have to pay the taxes. So you have to be very careful whenever you are having a multiple employment or any additional sources. If you're in this particular border, right? So if you are in this particular border of 12 lakh rupees, so then you have to make sure that you get it reported. So along with your other income, you can report this particular income to your employer, so that proper TDS will be get deducted without considering this rebate amount. So you will have a peace of mind at the time of filing of the return. Otherwise, you will have a surprise in the form of advance, in the form of tax payment in the June or a July month. In that moment, one-time cash flow can be expected. So be aware of that particular part, right? So
Chinmay sir, there's one connected question. That's why I'm just asking it right now. Is this 60,000 rebate only applicable for salaried income up to 12
so
lakhs?
no, so this is rebate is applicable to all the income which are taxable as per the slab rates. As per the slab rates, your salary your rental income, your income from fixed deposits or the bank deposits, dividends, everything is taxable under the slab rates. Only the special rates of income is there, such as capital gains and the income from virtual digital assets, online gamings. These are taxable at the flat rates. They have mentioned it as either 12.5%, 20%, 30%, right? Those things will not be eligible for this 60,000. So otherwise, slab rate, all the slab rate income, including the salary, it will become eligible for this.
Thank you so much. Dan, I hope that answered your question. Chinmay sir, you can move ahead.
Okay, thank you. The next illustration I wanted to talk about, like comparison between the which regime is beneficial, right? So at for an income who is earning up to rupees 24 lakh of income. So with the various types of investment that he do, like which regime is going to beneficial, right? So if he is earning, if a particular person is earning a salary of rupees 24 lakh rupees, again he will be getting the benefit of standard deductions. In addition to that, if he is having a housing loan to interest on the housing loan repayment and he has invested in the ATC instruments, he has taken the health insurance, NPS contribution is also making. So employer contribution, as I said, 50,000 rupees is eligible for under the both the old as well as the new tax regime, right? So now taxable income under the old tax regime and the new tax regime is calculated 18.5 lakh and 22.75. Here you can see under the old tax regime, he is almost invested from 23.5 lakh to 18.5 lakh, means almost 5 lakh rupees he has invested in one or the other investments, right? Whereas under the new tax regime, he has invested only 50,000 rupees. By looking at the taxable income of 18.5 lakh and 22.5 lakh, you may expect that under the old tax regime, you will be paying the taxes. Is lesser taxes in comparison with the newer regime, right? Will that be the case? Is that the case? So the answer is no, right? So even after making an investment of rupees 5 lakh in various instruments, he is by calculating the taxes by applying the respective slab rates under the old tax regime and the new tax regime. Under the old tax regime, it is coming to 3.82 lakhs, whereas under the new tax regime is 2.79 lakhs. If you calculate the average taxes that one person is paying, 3.82 is almost like 16 to 18 percentage of 24 lakh, whereas 2.79 lakhs is almost 12 to 14 percentage of 24 lakh, right? So here, even after 5 lakh of investment also, here the taxes that you are going to pay for the same amount of income under the new tax regime is lower than the old tax regime. Then you will wonder how much more investment that you have to do in order to get the old tax regime benefits. So in order to crack that, we have made the break-even table, right? So if you are making the investment in the form of exemptions or deductions, it is like we are calculating cumulative. So section 10, HRA, LTA, ATC, ATD, your donations, interest on education loan, housing loan, everything consider, you have to have this much of expenditure where you will achieve the break even between the old tax and the new tax regime. I mean to say the break even means the tax amount under these two regimes are equal. If you start investing exceeding this particular value, right, then only old tax regime will become beneficial, right? For 15 lakh of, so we have discussed about illustration in the previous slide for 24 lakh with 5 lakh worth of deductions. Here you can say in order to get the benefit of old tax regime, here you have to invest almost 7.87 lakh to achieve the break even, and anything above that will only benefit the tax under the old tax, right? So just assume that person who is earning 24 lakh rupees, he has to invest in the one or the other form almost one third of his earnings, right? So then on top of that, you have to pay the taxes, right? So here, like only this particular thing is possible only if you are like having no financial commitments, no family commitments. You are having whatever the money that you earn is freely available for the expenditure purpose. Then only you can achieve this. Otherwise, the making so much of an investment for a common man or a middle class person, this is not a feasible one, right? So the government is pushing more and more people towards the new tax regime so that with the lower tax rate, at least some revenue the government can extract, where the tax burden will also be greatly is not on the salaried or the middle class person, but government is also generating the revenue in the form of taxes for the betterment of the country. This is the whole idea of the new tax regime. I can tell you in the, I can say at the very high level part, right? So this is the break even point. So whenever you are choosing the regime, what are the main factors to be considered while choosing the regime? First one is the income level. So if your income is below 12.75 lakhs for a salary, right? With the closed eyes, you can go with the new tax regime. There is no requirement to think twice because zero taxes under the new tax regime. There is no requirement to uh, think again, right? If you are falling under the higher brackets, so you have the various avenues to make the investment. You will also have the money power to make the expenditure at that moment. Uh, Plan wisely along with your total portfolio. Make a majority of the portfolio that are in relation to the tax saving part, so that you can save the taxes also along with that, right? So next one is the simplicity and the compliance part. Under the new tax regime, you are not required to keep track of any of the investment or the expenditure. Simply like update your income part, whatever the tax amount comes, pay the taxes. There is no requirement to break your head, right? But under the old tax regime, you have to like make sure that X amount of money has to be properly invested before this particular point and submit the proof to the employer, get the form 16 corrected and get updated one, right? And track all your invested money value post investments. All this complication will be there. If you want to be like a simplicity and the compliance free person, you can go with the new tax regime. Otherwise, if you're planning to like take all this compliance tracking and everything, you can go with the old tax regime. Long-term saving capability. So with the old new tax regime, which provides you more and more money spending power by with the lower taxes, here you have to plan your investment on your own, right? So, but whereas under the old tax regime, with the forceful investment, automatically your uh, various wealth creation instruments are already taken care in one or the other forms. You are not required to plan it in a very drastic manner in order to build your wealth, right? Because PPF, EPS, NPS, and all these things already taken care, where is already your long-term wealth creation is already getting started with the old tax regime. So, considering the various factors, you choose your regime wisely so that wealth creation should also happen along with the optimization of the tax payments also, right? Switching between the two regimes, here like if you're a salaried individuals not having any business or professional income, there is no restrictions to switch the regimes. But once you choose the regime at the time of the final filing of the returns, right? Say that by 31st of July you file your original return by choosing the new tax regime, then you do not have the opportunity to change the regime to old again after in the form of revision or anything. But if you are like planning to choose the old tax regime, you have to file the return before 31st of July. Otherwise, mandatorily you have to go with the new tax regime after the due date if you have missed out the due dates. So these two things you have to keep in mind. Whereas in case of the business or the professional people, the default regime is new tax regime for everybody. But in case of the business and the professional people, you can switch to the old tax regime once, and once you come back from old to the new, you cannot go back. This restrictions has been kept. So the business and professional people, like while you're switching the regime, your timing is very important. Once you go to the old tax regime, at least you continue for a few years in order to get the maximum benefit. Because once you come back, you do not have the option to go back, right? Then you have to mandatorily go with the new tax regime only. So there are like additional conditions to file the form 10EA, 10IEA for the business and the professional people. Opting in and opting out, this has to be properly filed. Majority of the notices that we seen in the last year because of the incorrect filing of this form 10EA, we have been observed. So while you are like filing this particular form, very, very careful, right? Be very, very careful on this. Next one is simple habits to stay notice free. So, so if you're like properly filing the return by considering all your sources of income and everything, right? So there is the chances of getting the notice is very least, right? So unnecessarily, if you're like in order to do the tax savings, claiming the additional exemptions, showing fake deductions, right? And you are not even disclosing any of the particular source of income, all these things can prone to the taxes, prone to the notice from the department. So we have like bifurcated the to-do list, pre-filing season, during the filing, and post-filing the returns. What kind of the precautions that you have to take, right? Pre-filing the season, make sure that whenever if you are switching the employment, right? Make sure that whenever you go to the second employment after you have been onboarded, make sure to disclose your previous employer income in the later employer. how it is going to benefit, I will tell you. Say if your employer one during the initial 6 months, say that you assess the employment during the month of October. April to September, you would have earned like say 1 lakh upon 6 lakh is the income. And after that, if you are switching the salary, if you're switching the employment, there is an increment in the salary also, right? So up to 12 lakh rupees, there is no taxes. If you do not report your earlier employer income to the newer employer income, both the individual or both the employer will issue the standalone Form 16 considering your only respective employment. So that one Form 16 you will receive for 6 lakh, another Form 16 you will receive for 9 lakh rupees. Here the TDS will not be deducted in case of the both, and whenever you file the return, it will be merged. The income will become 15 lakh rupees. Automatically, the tax liability will come along with the interest. And one-time burden will come in the month of June or July. So make sure that whenever you switch the employment, the previous employer's salary has to be properly reported to the newer employer, so that newer employer will consider the current income as well as the previous salary income, and they will do the TDS cumulatively, so that tax will be properly deducted and there is no requirement to pay any additional taxes at the time of filing of the return. Simply submit your upload your Form 16 and get your file return is filed. And your Form 16 is only the not the tax calculation. You may be having some other income in the form of rental income, interest income, dividend income, sale of capital gains in the form of shares, property, mutual funds, right? So all these things has to be properly taken care and verify the same in the AIS. There is a special portal has been enabled by the uh, CBDT, that is the Central Bureau of Direct Income Tax portal, whereas reported to the government and it is populated in incorporate the same in your return and pay the proper taxes on them. During the filing season, properly choose the regimes and the ITR forms, double check the deductions and the exemption, as I said, before you claim them, and disclose properly all your bank accounts, fill the schedule as FA or the foreign source income, foreign assets and liabilities if they are applicable to you, right? If there are any large capital gain amounts are there or any of the cryptocurrency transactions are there, make sure you report them, right? If you have any doubt during filing the season, make sure to consult an expert. So just to save the consultancy fees or the fees of the profession, do not file the return in a risk manner. So it can impact you in the adverse case, like they can issue the notices 4 years later also, right? So make sure that you take a proper help from the expert before you file the return and the pay taxes on time. Post filing of the return, make sure to e-verify the return within 30 days. Failure of so, you will be deemed as you have never filed the return at all, right? So e-verification is mandatory, and whatever the claims and the reductions that you do, properly maintain the records of that, and respond to the notices and they keep the records readily accessible, because they can ask for any of the uh, supporting documents to any of the claims by the department if your return is picked up for the scrutiny, right? Make sure to have all the documents handy, right? But these are the checklist for the employees in order to prepare your self filing. Link your PAN with the Aadhaar as well as the bank account in order to get the refund. Linking of the PAN and the Aadhaar and the PAN on the bank account is mandatory, right? All the loan certificates, capital gain statements, TDS certificates, all these things has to be keep it readily available so that you can properly use of that and file a accurate return. In case if you are having any of the foreign asset income in the form of ESOPs, RSUs, or any of the investment that you do via Ind money or vested money directly in the US market or a UK market, make sure to properly report them, right? And the submissions for the rent, proof submissions for the rent receipts, right? LIC, PPF, ELSS, NPS, all these payment proofs, you maintain it so that it can be either physical or digital. There is no hard and fast rules for that. So keep it handy on a year and year basis based upon the claims that you have done. So this is the checklist, and these are the various types of the notices. I will not take much of a time by going in detail. Defective return means if you are missed out any of the source of income altogether, which is directly available in the portal, the income will be treated as defective, and you will be given with an window of 15 days to rectify them. Either you can rectify that or you can file the revised return if the option is still, if the duration is still present. right? Notice under section 143(1), this is the confirmation of the return has been processed, and if there are any arithmetical accuracy is missing or inaccuracy are there, that will get reported. And if there is any refund is there, or the tax demand is there, or there is no refund, no demand case is there, that will be confirmed with this particular communication. Since this is called it as intimation. And the government, if they have the opinion that that the claim made by you is something inaccurate, they can initiate an inquiry under section 141 by giving you the proper notices. It is mandatory for you to respond to any of the inquiry notices that is given to you. Otherwise, the penalty will be there. Section 245 intimation. This is in respect of current year refund. If any of the previous year you are having a demand, and in the current year if it is you are having a refund, this refund can get adjusted to the previous year demand. So that authority will be there with the government. So if something is going to happen, the before that the intimation will be given to you. If this particular if the earlier demand has been challenged by you in the form of appeal or anything as such, you can communicate the same, then the refund will not get adjusted, otherwise the refund will get adjusted. Last notice is section 148 notice. We call it as scrutiny notice or the income escaping assessment. This is something you have to be scared of, because if this particular notice is called for, and all your bank statements, all your source of income, everything will be questioned. And income, and if any of the unexplained income or anything is there, the tax up to like 60% can be levied, and 200% of the tax amount can be levied up to as a penalty. So this is the harsh case. So if you are getting any of these notices or anything as such, get yourself like verified or consult any of the expert to get a clarification around that, right? So with this particular note, so I will open up the forum for the Q&A. So where we will be discussing about the questions that has been raised with the that has raised in the chat box. So let's open.
First question, Chinmay sir, is under new regime. Am I audible to you?
Yes, please.
So under new regime for NPS, is it mandatory to have self and employer contribution both to be made, as only employer contribution is having tax benefit under 80 CCD?
See, like under the NPS, the scheme works in such a way that employer will contribute only when there is a employee contributions. So employer will not contribute on a one-side basis. So it is similar to the PF itself. So PF will get deducted from your salary. Equivalent amount will also be contributed by the employer, and together the lump sum amount will be deposited to your PF amount. Similarly, in the NPS also, along with your contribution, employer contribution will be merged. But for only for the tax purpose, employer contribution will be considered. Your contributions will not be considered under the new tax regime.
The person is thankful. Their question is answered. So I think for this one, you will have to show your previous screen. Is income of 12,75,000 or 12 lakh tax free in new regime? So I think you had shown the screen which showed how it's tax free. They want to see the screen again.
Is this one?
Yes, I think this is the one.
Yeah. So here you can see in the fifth point, right? The tax is calculated. So up to 4 lakh, there is no taxes. Again, next 4 lakh, 5%, 20,000. Next 4 lakh, 10%, that is on 4 lakh, 40,000, right? So togetherly, 1, 2, 3, it is amounting to 60,000, and salary is being taxed as per the slab rates, right? So entire amount is given in the form of rebate. So here is income of 12.75 lakh or 12 lakh are tax free in the new regime means. If it is a salary income, that is 12.75 lakh, because you will get the straight away benefit of 75,000. If this is not a salary income, if it is income from rental, say, right, or income from any of the business or a profession, then it has to be up to 12 lakh only, the profit part. So then only you will become eligible. Here, this actually, the 4 point actually matters. The total taxable income should not be more than 12 lakh rupees. Here you have to have a limit of 12 lakh. Before that, what and all the maximum benefits you can claim it here, and to arrive at this particular point. If it exceeds 12 lakh, then the entire income will become taxable. The rebate will not be given.
Thank you. What is the lock-in period for NPS?
NPS will be available only once you become retired, generally after 58 years, because this is the long period where you will be making the investment. And once you attain the age of 58 years, you will be given uh, 60% as a tax-free income, and the balance 40% you will be receiving in the form of annuity. That is the pension. So the lump sum amount that you receive, 60% will be completely tax-free, and the 40% that you receive over a period of that you can choose whether you want to receive uh, for next 10 years or the next 20 years, that you can choose. And whatever the money that you get in the form of monthly or annually, that will become taxable, completely taxable in the form of pension income.
Thank you. Next question is, can we invest NPS Vasalya 50,000 in new regime as part of employee deduction?
Under new regime, as I said, only employer contribution to NPS is not is eligible. Any contribution from our end, as a part of the salary or a direct contribution from our end, being an employee, that is eligible only under the old tax regime. To be like list out only the exclusive benefits that you will get under the new tax regime. One is the, as I said, the standard deduction of 75,000, and one-time benefits that we get in the form of gratuity, leave encashment, right? Once we leave the employment, gratuity we get, leave encashment we get, and this will become the completely tax free, and employer contribution to NPS. And there is one fund called Agniveer Fund that is specifically for the betterment of the defense people. If you are contributing to that particular fund, it will become eligible under the new tax regime. Otherwise, rest of the instruments are not eligible under the new tax regime.
Thank you. Next question is, so to know the best regime for self, we should check our investments and compare it with the break-even numbers you showed. And in case we have invested more than the said amount, we can think of choosing the new regime, correct?
Old regime. If
Old
the
regime.
if the benefits, if the that particular break-even point is getting crossed, then you can get the benefit of the old tax regime by crossing that limit. Otherwise, always the new tax regime is beneficial in terms of taxes.
Also, to everyone having the question, we will be uploading this webinar on our YouTube channel. So you can access the webinar and the screens later. That will be helpful to all. Next question is, if I sell an ancestral property, I am a 70-year-old person, do I need to pay capital gains on that? Selling ancestral property.
See, always selling of any of the capital asset, the ancestral property can be like land and building or any of the jewelry or any of the shares. I assume that this is the property means any of the agriculture land or any of the house, I presume. In those cases, the cost of that particular property you must know, right? Otherwise, you have to have a valuation done on 2001 estimated value. Then when you are selling that property, you have to calculate the profit element and you have to pay the taxes on that. There is no exemption on that.
Okay. Some people are asking that can you share your contact details, or like ClearTax can provide details so that if someone want to hire a CA for their more intense questions, they can do so.
Surely. So you can either at the end of this particular webinar, or already the particular partner page has been shared with you, where we will be providing the expert assisted plans, expert advisory, expert assisted plans. You can choose the right plan according to the requirement, or you can write to us directly at the on services@cleartax.in or support@cleartax.in, where we will try to understand your question first and what is the best possible solutions that we can give, we can provide you. And our dedicated relationship manager will also be there for the specific set of companies employees. They will reach out to you and they will surely be going to help you for sure.
Okay. Next question is, how to transfer Bank of America ROTH IRA account to India and avoid dual tax payment towards retirement savings?
So US Roth account is something you have to be very during the it is similar to the PF in India, right? Where you will be like parking the money in a particular account, and that money in turn is invested in the US market. If you want to take the money out of that, first you have to pay the taxes for the money that you are withdrawing in US, and you have to be compliant. Once you pay the taxes over there, at that moment your residential status matters. If you are a non-resident, well and good, you pay the taxes there and you will keep the money. If you are a resident Indian, then you have to make sure that that income is reported in India also, and you claim the foreign tax credit. That procedure is there, but it is a very short time for me to explain that. If you need any help, reach out to us. We will surely help you with that. We provide the assistance in relation to
So
that.
we have shared the link and in which you can access some discounted tax
Yes.
assistant by the expert. So you can check it out, and this link will also be shared in your feedback form. So you can also save it later when the
Uh,
tax filing opens. Almost last question is, if I have joined new employer on 16th April 2025, do I need to mention tax details of my old employer in financial year 2025 to 2026?
Interesting one. So initial 15 days of employment, you may not be have the great income, so that you can do a self declaration. So if you have received any of the one time settlement as a part duration this particular period, which is taxable, right? In those cases, better to disclose. If it is a small amount of money, not required to do so. Otherwise, better to do it.
Okay. Last question, Chinmay sir, is if someone has ESOPs and they sell and they are in 30% tax bracket, is there any way to reduce that taxable liability, or one has to pay full 30% on that ESOPs amount
See, like
when they are
sorry.
when the ESOPs are vested? Like they
Okay.
are, yeah,
So vesting part, right?
yeah.
Vesting part, there is no question of like prolonging it, because whenever the you get the right over on that particular ESOP, right? So you are already getting those ESOPs at a discounted price. Say that the market price is 100 and the you are paying only 80 rupees in order to get that money. On that 20 rupees, you have to pay the taxes. And once you sell that ESOPs, only on the profit element, say that 100 rupees you have purchased and 120 rupees you are selling it. On the 20 rupees only you have to pay the taxes. But there is no question of like shifting this particular taxation of the ESOP at a later point of time.
Oh, perfect. Thank you so much. Sharon, you can take over for closing in the session.
Yeah.
Yes, thank you, Vartika, and thanks, Chinmay, for the insightful session. And thank you also to all of our participants who have been, right through the call and who were connected with us through the content that you shared. So thank you and have a nice evening, everyone.
Yeah. Thank you very much. Namaste.